Welcome. In this video, we'll explore one of the most crucial aspects of building a successful investment portfolio: asset allocation. Asset allocation is the process of allocating your money across different asset classes to help reduce the risk in your portfolio from short-term losses in any one category, while also allowing you to capture different opportunities in the market. Let's get started. Asset allocation is the process of dividing your investment portfolio among different asset classes like stocks, bonds, real estate, and cash. This process allows you to benefit from diversification, a key component of asset allocation. By spreading your investment across various asset classes, you are diversifying your investments and reducing the risk of having all of your eggs in one basket. When one investment or asset class performs poorly, another may be performing well, helping to offset those losses. The right asset allocation for you depends heavily on your risk appetite, which is your comfort level with experiencing short-term losses, as well as your investment time horizon, referring to when you'll need to spend the funds that you're investing. As you can imagine, these two factors change over time, which means that your asset allocation across different asset classes will also change over time. Let's take a closer look at the different asset classes. Equities, also commonly called stock, refers to ownership in a publicly traded company. Publicly traded means that a portion of the company's ownership is available to the public for purchase via a financial exchange like the New York Stock Exchange or the NASDAQ. When you buy the stock of a publicly traded company, you become a part owner of the company and you participate in its profits and you experience its losses. Historically, investing in stocks has offered the greatest potential for high returns over the long run, but it also carries the risk of losses. Fixed income represents bonds or debt instruments that are issued by governments, municipalities, and companies. When you invest in bonds, you are lending money to the issuer in exchange for periodic interest payments and the return of the original invested amount at a specific date in the future, called a maturity date. Bonds are generally considered lower risk investments compared to stocks, and they provide a regular stream of income. Alternatives is a broad class of assets referring to anything that is not cash, publicly traded stocks, or bonds. Alternatives usually include investments like real estate, private company ownership, private lending, and hedge funds. These usually have different levels of risk and return compared to traditional stocks or bonds, and they help add diversification to your portfolio. Cash, including cash equivalents, includes things like a savings account, certificate of deposit or CD, and money market funds. These offer stability and liquidity and are a safe haven for funds that might be needed for spending in the short term. However, while they provide the lowest risk, they typically also offer the lowest returns when compared to other asset classes. By now, you've likely noticed that each asset class carries its own risk and return characteristics. The level of anticipated return is typically commensurate with risk. The higher the risk, the higher the expected return, and vice versa. The lower the risk, the lower the expected return. Earlier, we discussed how risk tolerance and time horizon influence your asset allocation. If your risk tolerance is high and your time horizon is long, you can afford a greater amount of risk in exchange for more potential return. This means that your asset allocation would include a larger exposure to asset classes like equity that have more return potential but higher risk. On the other hand, if your risk tolerance is low or you need access to your cash in the near term, you have a lower ability to sustain losses and should have a lower allocation to riskier asset classes. This means a larger portion of your investments should be in more conservative investments like fixed income. Asset allocation is unique to every individual, and there are many potential allocation combinations, as well as unique situations and complicating factors. A strong portfolio is well diversified by combining multiple types of asset classes and diversifying the investments within those asset classes to manage the risk and maximize your potential returns. Now, before you move on to our next video, please take some time to complete the exercises that we've provided to help you better understand the concept of asset allocation and your own comfort level with risk.